Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and today I'm glad to be joined by JP Baric, founder and CEO at Aurum Capital Ventures. JP, thanks for joining us.
Thanks again for having me on. I'm excited.
All right, well, JP, I'm excited. This is the first time I got to speak to you. So maybe let me and the audience know kind of who you are and how you got into blockchain.
Sure. So my name is JP Baric, and I run Aurum Capital Ventures, which is a cryptocurrency mining company. We're focused on optimizing stranded energy across the US and globe and building out large-scale mining facilities and then selling off hash rate to consumers and building out financial products for institutions to access hash rate as an asset class. I myself got into cryptocurrency and Bitcoin back in 2013. I was a freshman in high school and saw Bitcoin was going to change the world. So I got in, started learning a lot about it, talked to my teachers, talked to everyone in my family about it, and just kept, preaching, hey, Bitcoin's at $70. This thing is going to change the world. It's the only scarce money. And then really just met a bunch of very interesting people on the journey, and have just been working in the community and building since then. That's a little bit about my background and my story. And since then, I've just been kind of playing around with cryptocurrency mining, trading, building software products in this space. Never really did any of the ICOs, but just kind of watched from the sideline. And I've seen about, I guess you could say, 3 bubbles now, and going into maybe my 4th here.
And as you mentioned that Aurum really focuses on crypto mining. So what does that mean? You guys are finding mining operations that need capital, and you provide that capital, or you're literally building the whole thing from the ground up?
Yeah. So one of the things in the mining space is actually whoever can find capital is one of the, key roles in the space. It's one of the harder things to do. We found that at Aurum Capital Ventures, what we do is we're a full service firm. So we take it all the way from the stranded energy. So there's tons of wind and solar and coal power out here in the United States that is stranded or was built because of subsidies. So it's not necessarily economically sustainable. The power prices might be trading negative on the grid. So we go to those places and we offer them a long-term contract to buy their power and basically say, we're going to take 50 megawatts of your power for $20, $25 a megawatt hour, which is 2.5 cents a kilowatt hour, 24/7. And if you need your power back during the month, we can actually turn off, because during this event called peak load, they basically need that power back, and they have the opportunity to sell it for more money on the grid. So as a Bitcoin miner, we're able to consume a large amount of power consistently and sell it to the Bitcoin network, providing security. And then in return, we obviously get paid Bitcoin for mining that cryptocurrency. But on the power side, they're now able to get an off taker where they don't have to sell to the market. And as I mentioned, when the power prices do begin to spike, we can shut off our machines. And Bitcoin mining is one of the only applications out there that allow you to easily shut off your equipment. You can't really shut off an aluminum smelting plant, immediately. You can't shut off a car factory immediately, something that uses a lot of power. So we're excited to use Bitcoin mining as what we call a base load, or as a base load on the grid that then allows other renewable energy to be utilized and deployed and built, because we are consuming that unused power. That's what
JP, you just blew my fucking mind. Because I have some familiarity with the electrical production industry, and I understand mining. That is fucking incredible. I mean, that's such a good business model, because for those who don't know, the alternative power production in America and in the world, the problem isn't the production; it's actually matching the production time and peak production with peak usage.
Exactly.
We just don't have enough batteries. That is incredible. Wow, you just blew me away. So because of that alternate, like you mentioned, the subsidies, they're making more power a lot of times than they is used for, and you need to do something with the energy. Either it's wasted, or they're selling it for shit price, so you're getting a good price on the energy. And then the kicker is when they need it back, you're selling it to them for more than you paid, I imagine.
Exactly.
Oh my God, I got to get out of the journalism business and get into big crypto mining power usage. So that's incredible. So is this a similar, I know that's how the market works in America. Is this a similar kind of business model and market effect globally as well?
It's really, there are markets globally that you can do this exact same thing. In where we're doing in the US, this is really regional. It's going to come down to almost like, your city or your maybe 10 or 15 mile radius where these problems occur. because you, like I said, those incentives they have because of the wind incentives here, the federal incentives for generating renewable energy, they're going to get paid if they sell it. They just have to produce the power and sell it to the grid. They don't need to actually have it make money from the open market. So this happens in these little spots in the US and the world where you have a ton of power generation and no consumers. And so the power has to go somewhere, as you mentioned. You can't just not use the energy. And so in California, we have the duck curve where there's tons of solar online. And then when the solar turns off, we got to turn on natural gas and coal plants to fulfill that. And so we're working on, as I mentioned, building that base demand so that these areas where the power is really cheap and is trading, maybe in the negatives, we're able to provide that constant supply and make sure that energy is not wasted. But then also, more importantly, as I mentioned, make sure that natural gas and peaker plants don't turn on during those peak loads, and we're just able to relinquish our power rights. But yeah, the business of mining is something where it's scaling, it's growing. The past couple of years, it's been about $5 billion a year in mining revenue. Expected to go to $20 billion a year in mining revenue in the next 4 years because of this halving event and the Bitcoin price moving up. I would say it's one of my favorite parts of the industry, and one of the things I see the most just interesting because it really deals with the physical world. It's really what connects Bitcoin to the industrial side of the world. It's what creates that base price in Bitcoin and what creates the energy, what's the energy required to keep this massive infrastructure running, or this massive network running. And so as a miner, it's a very cool game because you're in this energy and debt financing world, which means you're working with huge numbers. Building out a 50 megawatt facility is $50 million capital raise. And so before, I would say in the past couple of months, really you had to pay that all in cash. And so now with we've had some recent private lenders step up in the space that are actually willing to lend capital to let you buy miners on with debt. So you only need to raise maybe $10 million in equity, and then you can use $40 million in debt to fundraise that. So we're seeing that the space is maturing rapidly. You're able to source these miners more efficiently and on a production schedule from companies like Bitmain and MicroBT. And then next thing is, the insurance companies are starting to step into space where it's like, if you're in any type of infrastructure project, the most important thing is to make sure that everyone can get paid without anyone taking any risk. And that's when the insurance companies step in and they help underwrite those policies to make sure that you can pay your debt and interest payments, no matter if the operation fails or no matter if you have a long delays. And so now it's working about how do we take out any perceived risk or risk on these facilities.
And I think this is also really important for a lot of people out there who, when they hear about Bitcoin and they'll see those headlines, the Bitcoin network uses more energy than Switzerland, or they always have these crazy headlines. And then people think, whoa, we're wasting all this energy. What are we doing wasting all this energy? When in reality, it only really is economically viable to mine when you're mining using excess energy, usually next to some sort of alternative, powered by some alternative energy source. And so I do think this is crucial because people, for some reason, at least the mainstream, kind of had this notion that Bitcoin is just like burning the world on fire just cause. I don't know, but I mean, it's industries and companies like yours that are showing that no, it actually is economically viable to use energy when it's low and when it's alternative. So kudos to you there. I wonder, a couple of months ago, when Corona first hit, and the price of oil in Texas was like negative money for a barrel.
Yeah.
Like, you guys just buy up all the oil in Texas while it was down low?
No, we didn't. We are looking to start trading, in the energy markets and in the electricity markets more. But no, we were not trading any of the oil. But when that happened, it kind of sent shockwaves across, I think, all the other major industries to understand that, my commodity price can drop negative. Then how, we have massive amounts of infrastructure built on oil, massive amounts of debt built on oil. If I have an oil field, I can lend off of that oil field reserves and someone's going to pay me for it. That's insane to think about, that when that oil price is negative. With Bitcoin, we don't really have that option. You can't lend off your future Bitcoin reserves for the next, 2 or 3 years from a Bitcoin mine. So it's made financing it a little bit harder, and just even financing and insurance and even purchasing Bitcoin miners with a credit card or using PayPal, something like that has been impossible because of us selling computers that touch Bitcoin, or us working with computers that then their value is determined based on the price of Bitcoin. So it's been interesting to see these, these massive organizations kind of come in and start changing their perspective on crypto. And what excited to see if they, start changing their perspective on mining as well, with, the PayPal news and other news that came out.
Mm-hmm. Now, hopefully you could answer this question, and it might be a really dumb question, but it's something I've always thought I never really properly understood about mining Bitcoin. If everyone's racing to be the one who mines that block, and whoever wins the block gets the reward for that block, so there are tons globally of Bitcoin mining operations. So like, what are the odds of your mining operation winning that block reward? Like, how many block rewards do you win in a day? And even if you have this massive farm, but there are tons of massive farms. So like, is it just a statistical probability game that, based off the amount of power you have, you're going to win 30% of the time, and therefore you do the math, or
Yeah.
like, how is that what it is?
Yeah, so you can everyone joins a mining pool, and the mining pool is where we go to get steady payouts. But you're right, our facility could be running for a year and it could only get maybe 2 blocks, 1 block. I mean, that might even be considered a lot, because, that's the thing is, we're always contributing to the network. And so these pools, they take the aggregated hash rate of everyone in it, so everyone that joins, and they send it to the Bitcoin network, and they get paid on, through the Bitcoin blocks. And because there's more people working together, then that reduces the risk for everyone. And so that's, one of the key components of Bitcoin mining, and the reason why we can separate out our profits, or ensure we have steady revenue and don't have to worry about getting those Bitcoin blocks, as you mentioned.
Mm-hmm. And so right now, essentially, the days of definitely not an individual, but the days of a single entity kind of really being competitive in the mining space, that's kind of over? I mean, you kind of have to be. It's just like 4 big pools at this point, or 5 big pools that are just alternating winning these blocks.
No, I mean, there's definitely a lot of pools. I would say there's at least 15, 20 pools. There's a lot of smaller communities. I mean, to be a miner, one entity, yeah, you could definitely do it. It's not impossible. Like the 50 megawatt site that we're building out in Oklahoma, that's gonna be 1% about the Bitcoin network, maybe a little bit more. So I'd be able to get, a block potentially once every 3 days by itself. So it's still feasible. We're seeing that larger scale miners are out there, and usually they are concentrated into these single entities, which are getting, considered block rewards. But, to my point, I think there's a lot of teams that are working on the pool level and to provide value. And those pools really they buy your hash rate for a lower value. They add a fee and they sell it to the network for that consistent payout. And so I think there's going to be changing in how pools work, and kind of like the rewards that they're putting out. You see with Binance, when you mine Bitcoin with them, and if you keep the Bitcoin with them, they actually provide you interest on those Bitcoins until you withdraw them. I don't know. I think what they're doing is that, they're lending off of those Bitcoins, or they're leveraging that in some way. But it's an interesting concept. Now Bitcoin mining as a service is really a steady way to dollar cost average into Bitcoin throughout the lifespan of the miner, and also lets us speculate on the value of the hardware. So this infrastructure that I mentioned that banks and insurance companies are kind of ferret away from, because the value of those machines will trade based on the Bitcoin price. So when Bitcoin price goes up to 20K, like it just did, the value of those machines will shoot up, maybe up 30%, 40%. And so now you have these machines that you might have thousands of them running in your facility that just went up 30% in value. And now they're making more per day because the difficulty has not caught up. So right now, new machines are sold out till April 2021. And this is November, this is Thanksgiving, and then Christmas time. Like, we're not there yet. And then next thing these machines are going to be deployed and built out in the facility, but you just can't turn on a mining operation, by just clapping your hands and saying, wow, it's done. These are massive projects. 50 megawatts is 100,000 homes of power that are deployed and running in these facilities. And it's what keeps Bitcoin secure. It's what keeps Bitcoin, as you mentioned, like that waste of energy. It's really what keeps the network running. And most importantly, it's what keeps everyone incentivized, because miners are taking a really long position on the Bitcoin network and are taking that risk to say, I believe this coin is still going to be here in the future. And I believe that so much that I'm going to go put $50 million into infrastructure to support it.
Mm-hmm. And you mentioned it is such a big upfront infrastructure and capital investment to buy these machines, build these massive facilities. How at this point, how long is that machines like stay effective for? Essentially, every year, new, more efficient and faster machines come out. So you just build this massive facility, you fill it with Bitmain miner 10. Does the once 11 come out, is that facility now useless?
No, so thankfully, there's 2 or 3 inputs that go into the Bitcoin mining like equation. One of those is our power price. And so our power price is going to it's going to let us know how profitable we are and how much we're spending on that bottom cost, which is about 80 to 90% of our cost is power. And so having a low power price is going to let you compete with all the other miners, but longer than them because you don't have less money to spend on electricity. That's number one. Number two is the efficiency for the machines. So that measurement is called joules per terahash, and that's how many joules of energy it's cost to create 1 terahash of mining processing power. And a terahash is think about it as like miles per hour. It's how fast these mining machines run. And so that determines how effective you can turn that 1 joule of energy into a terahash. And so these new machines that are coming out are like 30 joules per terahash or 31 joules per terahash. And so the older machines, the S9s, were closer to 100 joules per terahash. And those came out about 4 years ago. So in a 4-year period, we saw about a 2 to 3x increase in efficiency on the machines. They did get bigger in size. So that's why I said 2 to 3x. And then you deploy these machines, they're going to run for probably 4 years, 4 to 5 years at that 2.5, 3 cent power rate, low power cost. If you have 7 cent power cost, it's not going to run as long because that margin of, that 3 cent margin, 4 cent margin in there goes straight to the electric company and no one, it doesn't go anywhere else. So you then won't be competitive because really as Bitcoin miners, you're always looking for that stranded energy so you can stay competitive. But then more importantly, there's that arbitrage between the Bitcoin price and Bitcoin difficulty and your cost of electricity. And that Bitcoin difficulty is relative to where everyone else in the game is able to get on hash rate. As you mentioned, you don't have to ask anyone permission to get on the Bitcoin mining network. You can just deploy a miner, plug it in, and you're running, and you're getting paid a day-to-day fee. And so people can do that all over the world, and people do that at scale with thousands of machines. And so as more and more people turn on their machines, it becomes less profitable for everyone. Because as you mentioned, how do you get paid? How does this consistently work? Yeah. Every terahash gets paid a flat amount per day. And so right now that's about 13 cents per day. And that's with basically, as long as it's running that whole day, it's going to get paid. And if it's only running for half the day, it's going to get paid half of that. If it's running for a quarter of the day, it's going to get paid a quarter of that. But basically just the network is paying you for securing it, and it pays you every 10 minutes, which is super cool.
Right. That is pretty awesome. So it's pretty much it's a complicated operation, but pretty simple equation. You just have to make sure that your payout from the pool covers your costs, and to help subsidize that and help that out, you guys actually figure out how to get cheap energy by buying excess energy, and also on top of that, selling that energy when it's needed by the grid back to the grid. So you covered that electricity cost. You've covered supplementing your income by selling it back to the grid. I wonder if anyone's doing this though on the actual Bitcoin miner side. Mining operations, I'm sure, require a shit ton of heat, and you need to pay for crazy cooling. But I wonder if there's actually ways of harnessing all that excess heat. There's so much heat there. I'm not sure how hot it is. Is it possible to run steam turbines off that heat? Is it possible to harness that heat so now you're actually also getting another stream of income on that farm as well?
I mean, a lot of people have looked at harnessing heat, and it's one thing that we've looked at as well. Obviously, it's not as lucrative as Bitcoin mining itself. You can have a tilapia farm. There's people that grow marijuana in legal states. There's people that are looking at how do you take it in, put it into a turbine. But you have to really focus, I think, on the design of your building and ensure that the heat is exhausted. Right now, one of the biggest problems, I think, to collecting the heat is that, these buildings are 500, 600, 700 feet long. They have hundreds of fans exhausting the heat, and it's not exhausting it all in one spot. So the heat is, coming out kind of just like I said, over that 700 feet area, which makes it a little bit harder to capture because, you know,
Mhm.
heat dissipates very quickly, especially during a cold day. And it's now you're dissipating the heat, you know, on the roof. And so it's like, what can I really do on my roof? Is it worth putting, you know, a
Yeah.
garden up there?
Yeah.
But, you know, I think there will be more use cases for the Bitcoin byproduct, which really is heat. And just using, you know, Bitcoin miners in unique areas where energy is very cheap or stranded as well.
Mhm. And of course, this only works for a proof of work. Sorry, consensus like Bitcoin. And at the beginning of crypto, kind of that was the consensus model, proof of work. You know, Ethereum
Yep.
was also proof of work, and everything was proof of work. And so this is very exciting. This whole mining go really was such a massive thing, and still is. But now it's become. It seems like it's become. It's really Bitcoin. Ethereum is still there, but they're moving slowly but surely to proof of stake. And so it seems like, will it really only be that Bitcoin is truly the only, like the real only legacy blockchain that will stay proof of work, and really all blockchains going forward? I mean, it just makes sense to be proof of stake.
I would say, you know, I think Bitcoin is the biggest and will probably always be the biggest proof of work blockchain, in my opinion. There are 5 coins at least that have $1 billion market cap, or $1 billion worth of mining rewards per year. So Bitcoin's at 5 billion, or 6 billion now. And so those coins, you know, were, I think, Litecoin, Zcash, Ethereum, and maybe Dash. And Ethereum, you know, no longer is, you know, is going to proof of work, is going to proof of stake, as you mentioned. But I think that mining is an interesting way to incentivize a group of people, or even like a community, with ASICs in particular, which is kind of, these ASICs are what a Bitcoin miner is and what it's called, the type of computer. It stands for application specific integrated circuit, and these are computers that can't do anything else. So when you buy a Bitcoin miner and it's done mining Bitcoin, you can't actually use it to do math. You can't use it to do
Mhm.
GPU coding or
Mhm.
transcoding. You can't do anything with this computer. And so I see that there be more GPU mining, and I think that'll stick around. I think people will continue to build other networks that use graphics cards. I don't see them continuing to build ASIC networks because they're very costly. And like I said, you need a dedicated reason to go to proof of work. And a lot of the privacy coins are already very popular and are already out there. But I don't necessarily see like another type of coin, you know, with like the recent rise of DeFi and everyone kind of focusing on that and building on top of that. There's really, you know, I wouldn't say there's no reason for mining, but unless you need a distributed consensus model,
Mhm.
and you need to make sure that it's secure, you know, that's, I think, that one of the big reasons why people do mining in general. But proof of
Mhm.
stake, you know, also is secure, and it also is a distributed consensus model.
Right.
So I think that, you know, we are seeing kind of like, I would say, proof of stake version 2 coming out here, where we're trying this. How do we go completely POS, and can this actually work? And I think proof of stake just has a, you know, different type of incentive model, but we'll see. I really don't know if we'll have
Mhm.
more large mining coins. I would like to hope
Mhm.
so, but I
Mhm.
don't know.
Yeah, and I guess it's kind of hard at this point, just because of the way the system works. Obviously, the more valuable it gets, the more secure it gets, because the more costly it is to do that 51% attack. So it's kind of a catch 22, because if you want to start off, when you're starting off, you're going to have so little hash rate on your system that the second gets valuable, I guess people are going to hop on and try to do 51% attacks. It could be that Bitcoin is the last big one. But um, right now, if we're looking at the mining space, we're talking about the makers of those miners, because that really, these ASICs, as you said, really power the Bitcoin mining field. At this point, it's useless to use GPUs or CPUs. It's basically just two big companies, right? It's Bitmain, and is the second one Canaan? I believe it's Canaan, right? Is that what it's called?
Kanon, I would say, would be the third, and
Okay.
MicroBT is
Uh-huh.
the second one. Bitmain would be the first, like,
Uh-huh.
largest player in this space by volume or by total hash rate.
Mhm. And are we getting to the point where this market is big enough that even like the big GPU makers, NVIDIA, and we're talking about like actually the big traditional hardware makers, that they're actually going to say, well, maybe we should start producing our own line of ASICs?
Yeah, so I think Samsung, you know, is in this space. There's some pretty big other companies that are looking to deploy capital or already designing chips. I expect that with Bitcoin price rising, potentially $150,000 in my opinion over the next year and a half, it's going to happen. These companies have been sitting on the sideline. They've had projects in the works, or they've kind of like put the gas on the pedal and then pulled it off when in 2018, 2019, when they said, okay, Bitcoin's dead. But I think that the fact that if you make semiconductor chips, there's a huge opportunity to print money with these chips. And that money's always been here and it's consistent. That's going to be huge. And I think companies are now realizing that in the energy space and in the finance and computer sector. So I wouldn't be surprised if, these large manufacturers that you're talking about start to actually build out their own ASIC models and chips. It's very hard to compete with Bitmain because they have very good IP and the chips are very efficient, but it is doable. And the most important thing is getting consistent chip flow from the factories, because that's what takes the longest. And that's where they're already backed up a lot. And those chips could take 3 to 4 to 5 months to get, as I mentioned, depending on the backlog at these factories in Taiwan and other places.
Mm-hmm. And is there a possibility, that if Bitcoin becomes, I mean, it's already ridiculously valuable, but either now or in the future, when it becomes more and more valuable, that a company like Bitmain says, hey, we actually could make more money making all our ASICs and not selling one to the public, literally just making as many ASICs as we can and just mining the shit out of Bitcoin for ourselves. And that would be more profitable for them. Can you see a future where we get to that price point?
Well, I would say that was actually the future that Bitmain had. That was actually in their past. And so we had that, they did that. And they did that in 2013, 2014, 2015, 2016, 2017. But the biggest problem that these manufacturers have had has been able to front the capital for that long lead time items. Mm-hmm. And so for them, when Bitmain has an order now, and kind of how they're working with larger companies, is you go in and you can get a production schedule set. So like, I'm going to buy 3,000 of these miners for the next 4 months. And we write them a check and we sign a contract. So they're actually now incentivized because they can actually plan that production out. And we've already paid for that production, because you pay for like 50% up front, and then you pay 20% when it goes to the next spot, and then the remaining 30% when it ships or before it ships. And so it came down to they didn't have enough capital to front to buy those chips. But now if you work with other parties and you're able to deploy your machines on time, then you're hopefully able to get that original customer to buy those chips and spend the money or the carrying cost on that capital, the interest cost there, to put that money to the manufacturer to then wait 3 or 4 months to get those machines. So I think that these manufacturers realize that it's super important. They only can get so many chips, but it's super important to set these long-term agreements with your customers and try to just manage your production cycle and try to get more capital in, then instead of like holding on all the machines and raising the prices up. Like usually Bitmain and them will raise the prices when Bitcoin prices go up dramatically. And that's what they did last time. Now it seems like for the people that are actually buying these machines at scale and are looking to finance them, they're keeping the prices pretty not low, but where they should be, and they're not raising them, which is interesting to me because it shows like, okay, the industry is maturing, because now they understand it's not about, okay, I could gut this guy and make a couple more dollars per terahash. It's more about, I need to give this guy a constant price because he's going to buy these machines for the next 6 months for me and do $50 million in sales. That's huge. I need to keep him happy. I think they're starting to realize that these bigger farms, that they've been in this industry, they've invested their money into it. Bitmain understands, and they don't have as much control of the market as I think they did in 2015, 2016, that they can't piss everyone off like they did, and they need to deliver their products on time, which has been hard for miners to do historically. I mean, one of the companies back in the day was called Butterfly Labs, and the joke with them was that, oh, you'll get your miner in 2 weeks, and 2 years later, these people still don't have their miners.
Right. Well, and obviously the Bitmain had its controversies and struggles up top with their heads, but it's good to see. It seems like things have stabled out a little bit now. But you keep on mentioning this idea. You mentioned a couple times in this interview that the big issue here is capital. It's capital front, because it's a huge upfront cost for people who want to run these mining operations. And so, I wonder. It seems like this would be such a perfect use case for raising capital from the community, like a decentralized fundraise, instead of an ICO or an IDO or any of these things. kind of a mining operation going and giving out, a tokenized version of equity, on this upfront loan by the community. And I think it works better here than in other places, because I mean, you could tell me going as a VC and going to traditional money, going to traditional investors and trying to sell them on, we're going to open up a Bitcoin mining thing. You got to explain to them why Bitcoin's valuable, what the hell mining is, why this all works. So one, I want to hear how hard of a sell is it to try to get traditional investors into it. And then once you're done with that, then we could talk about, the possibilities of potentially doing a decentralized raise for them.
Yeah, so I would say it's hard. It's not impossible, but it's hard. And there's hundreds of conversations that we have, lots of podcasts, to generate interest in the energy space and the finance space. And then from there, setting up meetings with people who usually hear me on those podcasts. And that's really where the conversation starts. And then, depending on who you're talking to, you're right. You're answering questions about energy, about the price of Bitcoin and where that's going to go, and how hash rate and Bitcoin price and difficulty play about over the past 3 or 4 years, how Bitcoin miners come into the space, how new miners are made, and what's the lead time, how the energy, how your energy contracts are set up, how you build these facilities, how you manage, how you sell the hash rate, what's the life cycle of these machines. All those questions are, come up in these conversations with investors. And it's hard. You're trying to constantly educate, but it's not, like I said, I think the past 4 months has accelerated the awareness or growth of the industry and the financial awareness. These companies looking at it saying, okay, we should be able to underwrite this. This isn't too hard to underwrite. Mm-hmm. Regarding your comment on crowdfunding, and I mean, I would love to do it, but in the United States, it's very hard because the security laws we have here to crowdfund out the operation like that. I don't think it's impossible. There was one of the biggest ICOs back in 2017 was a mining company. I think they're like top 5, and they ended up not even building a mine or doing anything. They lost all the money. Yeah, that was a scam in Jersey. I think it was based out of New Jersey. And so it's just like, come on, guys. Like, if you're gonna do all, like, because then all these people are investing in it, and like, I saw the project, I was like, okay, this is too good to be true. Like, there's no way they're gonna execute on this. Like, but it's sad they raised like $40-50 million to try to build a mining facility, and they didn't even get one off the ground. And so kind of where I'm going with that is that I think it's possible and feasible to do this, with the idea of the community getting involved. I almost don't view it as an equity play, which is, I think, how you presented it. I view it almost as like a debt play, where if I am a crypto participant in the market and I have my cryptocurrency, the goal would be that I could give it to you as a miner and lock that up on your balance sheet or in like a bond asset. And then I could get paid a steady yield on that crypto, 12, 13%, 14% maybe. That's what we're paying for the interest for these miners and for this capital. So if we paid the community the 14% interest, now that could potentially be huge. And you could just lock up your crypto in a vault. We would then lend off of that crypto and mine Bitcoin with it and provide you, 13, 14% interest. The problem with the crypto lending portion is that you're not able to get one-to-one backing, and you can, if the price goes down, then you're now potentially have to pay off that loan. But the thought process is how do you provide a steady fixed income supply to the community where it says, hey, if you're a Bitcoin believer, I want to pay you Bitcoin plus 10%, or I want to pay you US dollars plus 14% every single year, so that you can continue to grow, and you can't get that yield anywhere else in the traditional world. So I think those type of products, we're working on some will come out in the next couple of years to provide the individual, get them back into mining, as you mentioned, but they have to do it at the scale that we're doing it at these massive facilities, in Oklahoma or in Texas or wherever they are in the world. Mm-hmm.
And like you mentioned, so much of what you're trying to do is tied to the price of Bitcoin, is predicated or dependent on the price of Bitcoin. Because if the price of Bitcoin goes below a certain amount, all of a sudden your mining operation is no longer profitable. That equation doesn't balance out. And so I wonder, as you're going to investors, kind of which way to look at it. On one hand, I see, because essentially if you're investing in Bitcoin mining, you're investing you're going long, like you mentioned, on the price of Bitcoin. You believe Bitcoin will go up. So I wonder, which is that better investment? Because if you're already going to go long on Bitcoin, do you put it into mining because this way you get the upside of Bitcoin plus, all that interest on the loan and all that benefit of the mining operation? So then the question is, why would anyone ever just buy Bitcoin if you can invest in a mining operation? What's the downside to investing in a mining operation that gives you that long-term exposure to Bitcoin plus all the interest you're going to get when, why would you do that over
yeah, I mean, so the question of why buy versus mine, basically, and that's that's where we come into play, and where you're running these numbers over the past 4 years. That question basically has changed. Like the answer to that question, okay, which are going to be more profitable, to buy or mine Bitcoin? It's kind of flipped back and forth, because what plays into that equation is that power price. So if you have a very low power price, it might make more sense to mine that Bitcoin, put that capital there, than just to buy it, because it might not appreciate as fast. But the one thing is, we don't know how fast Bitcoin is going to appreciate in value. We do know it's going to occur, at least in my opinion, but we don't know how fast it's going to occur. So the mining equipment, depending on when you get it, has different values, different price points. So when you were buying a miner equipment, I believe in 2018 in S9, or when it came to 2018, that machine was going to make you more Bitcoin than it cost you, because it depends on where you got that equipment, what price were you able to get that at on the market, versus how many Bitcoins did it generate for you over that lifespan. And so that equation will change. We've seen that it is more profitable to mine Bitcoin and hold all those coins, and only sell the coins to pay your power bills if you can. But even selling, just holding all the coins or having portfolio management is super important, because a mining operation, you have those costs, you have the Bitcoins on the top. You have to be able to make sure that you can make that equation that we talked about, the simple math equation, work consistently. So when it comes to mining crypto, you do have that longer outlook. Really what appreciates is the value of those machines, so that those machines will increase in value, and with the Bitcoin price. And then you also have the cash flow from that machine. So that cash flow will increase or decrease in value depending on the Bitcoin price and difficulty. And that's the gamble you're taking as a miner. You're like, can I get more Bitcoins? Or really kind of where we are now is, can I use my equity capital and raise debt with that? So then I can actually take $10 million and get $50 million of Bitcoin mining exposure. Now, when you start running the calculation like that, now you see, oh, I can get a lot more Bitcoins because I'm only spending 10 million, but I'm deploying 50 million in capital. And so I think that's kind of where we're super excited for, is being able to use leverage and then being able to use insurance to basically capture more Bitcoins with fewer dollars and putting our dollars to work farther.
Mm-hmm. Yeah, and it keeps going back to that same equation of the cost of power and to mine that Bitcoin. So I wonder, when you're going to traditional investors, because on the flip side of that equation of being long on Bitcoin is being, I guess, short on energy prices. Like you believe that energy prices are just going to go lower and lower as the grid becomes more efficient. It goes more to alternative powers. So if you're an investor, if you're in the energy game and you look at the future of energy production, you say, hey, I think the price of energy is going to continue to go lower and lower. Would that be a pitch that you would do to them? Would you say, like, not even focus on the whole Bitcoin side of things, but say, hey, I have a thing that requires energy to make money, and the cheaper energy is, the more money you'll make. Is that even an angle in the sell that you could go to investors?
I think it definitely is a part of the sale, but it's not that key of a component, because they understand, most investors don't understand how localized the energy markets are. As I mentioned, you have to go find these energy pockets. And so you're only gonna be able to find them in like certain areas, usually very, very rural towns where there's not many people and there's a lot of energy being deployed. And so those power prices are dropping consistently all across Texas. And that's important to keep your costs down. But really, most of these investors actually want you to lock in your power costs for the next 5 years or something, because that gives them it gives them protection that the prices of power are not going to rise. And more importantly, they want to hedge as much as they can. They would rather just have a vehicle that gives them, 15%, 20% every year, unless compared to like, okay, how do we squeeze out an extra 2 or 3% here? But we do see power prices continuing to drop because of, as you mentioned, all the new renewables coming online. And in ERCOT, I believe, we're in for the lowest power pricing already in the wholesale market. And that's in Texas, where they have a free market to trade thousands of gigawatts of power.
Mm-hmm. Yeah, that's the beauty of Texas, baby. That's it's an open market. I love it. Now, that's another thing. If you look at like you said, you were interested in Bitcoin since 2013, and Bitcoin mining back then looked very different than it looked today. I mean, back then, if you were a hobbyist, if you were interested in like, hey, I like Bitcoin, you just attached a couple computers to the network, you could be mining some Bitcoin. And so definitely then it was all Bitcoin enthusiasts.
Mm-hmm.
And I think now I was just looking at your executive team on your company page and the company advisors. It seems like a lot of energy and energy financing backgrounds.
Yeah.
And that's the thing is nowadays as it's turned away from Bitcoin hobbyists and enthusiasts to this whole like massive like really big capital investment in energy just mammoth. What percentage of the mining industry would you say are crypto people, and what percentage are energy and financing people?
Right now, I would say it's probably 70% crypto still, 30% energy. We're seeing that the energy companies are like, hey, I'm not making any money because oil's not worth anything. So what are we going to do? Or let's start looking at this Bitcoin mining thing. Or I have flare gas and I want to mine Bitcoin. But they're still not comfortable necessarily with the asset of the Bitcoin miners. And even like you said, they're not necessarily looking to get Bitcoin exposure. They're just going to sell for dollars and go long dollars. And so every time they mine Bitcoin, they can get the liquidity every day and they can sell their Bitcoins. And so we've seen energy companies, we've been talking to them for, I would say, 2 years now across the globe. And we've seen that story is now coming to a point where it's like, oh, I'm interested. And let's talk farther, because now these funds, these energy funds and these energy companies, they have to actually add in their prospectus or their kind of like investment thesis that they can either consume energy at scale, which is Bitcoin mining, or they can do Bitcoin and Bitcoin mining itself. So if these companies or these funds don't have that in their perspectives, then they aren't able to actually put capital towards it. So that's why finding private lenders and financing, I think, miners is going to be huge, and we expect to see this space really, really grow because of that over the next 5 to 10 years.
Mm-hmm. Well, you're the first Bitcoin mining focused company that I've spoken to. I've done a bunch of these conferences already. I think it's my fourth one. It's mostly financial teams and different projects in DeFi. So I always ask them. It always comes up. The question of regulation always comes up in speaking to them. Is regulation stopping your exchange from growing and yada yada about regulation? And I wonder here, the regulation in this space, in the mining space, that's so closely tied into energy and energy credits and all these things. You mentioned America and also globally. I wonder, is regulation something that you have to kind of avoid and it's holding you back, or here it kind of seems like it's helping you guys because of this regulation is creating these subsidies that is creating this excess energies. Is the regulation actually helping propel the mining industry here, or is it like in a lot of other places holding it back?
I would say, so there's two types of regulations that affect our industry, really. The first one is the energy regulation of the energy industry. The second one is regulation of the hash rate industry. And so the energy industry gets, there's renewable credits, there's regulation on gas producers, on people that use coal, and that affects the power prices negatively, in my opinion. It makes it so that it isn't a free market. You have people that are using fossil fuels, which then have to pay extra tariffs and taxes, and then you have people that are using renewables, which are actually getting paid to deploy the power. And I get it, we're trying to switch off of coal power and go to green power, but that's not sustainable. And we're doing it at scale where it's all about the tax credits and more about just putting the money to make sure these energy companies, can be profitable. And these investors like Warren Buffett are able to write hundreds of millions of dollars off on their taxes. So that's helping lower energy prices, and it is keeping energy prices up a little bit on the coal. But the thought process of that is that, the more we subsidize the energy, the lower it's going to go. That's there. I think there's a lot of regulatory things on the grid itself that hurt Bitcoin miners, where actually it's very hard to get power for less than 4 cents in the US because of just how the rate classes are. There's a lot of regulatory bodies that really don't do much, in my opinion, on the grid. And the reason why I say that is because they're extracting fees. They're companies that are massive utilities that don't maintain the grid well, but just extract fees for delivering you power. And that's why you have power for 7-8 cents in the United States in most places. And so I think there's a huge opportunity to kind of deregulate the grid and really make it more of a fair, free market like Texas. But even in Texas, you have some of these same issues with power costs. So that's one area. The second area would be on the sale of hash rate. And I would say the sale of equity. And that's what I think is we're being held back, as an industry. We can't sell we can't sell the hash rate here. We have to actually sell your physical machine in the United States, simply because it's a security and it doesn't pass the Howey test if you're selling just hash rate as an asset class, which means that if you're not a accredited investor, you can't buy the product. So if you don't have more than $1 million, and that's just, it's not how an industry like this can scale in the kind of the crowdfunding model that you're referring to. So I see that as holding the industry back. And then also regulatory clarity. Banks, there's Operation Choke Point, and they don't work with mining companies. They don't work with, pornography companies. They don't work with weed companies. They don't work with anything that's considered a sin business. And that really hurts our ability to process credit cards. There's some points in my career, that we weren't even able to process credit card transactions, or we spent months trying to do that. PayPal would shut down accounts. Banks won't support you. Like I had accounts at Wells Fargo and Bank of America. Now it's like, hey, you're a Bitcoin miner. You don't want your account, go somewhere else. And so no banking. And then also loans. We can't get financing, even though we buy, hundreds of millions, not hundreds of millions, but tens of millions of dollars of power equipment that everyone else can go finance that builds data centers, but we can't. So we have to pay all cash. And so there's no lending to this space to lend this for this infrastructure. So all of that regulatory, I would say lack of clarity and lack of regulation has made the mining a much harder industry than it should be. But then that makes the return profile better, because, to actually deploy all this capital, it takes a lot of time, energy, and money. And that's my thoughts on the regulatory environment currently.
And then last question before I let you go, because I know you're very busy. My question on every interview has to have COVID involved. So what effect has COVID had on the mining, whether it be because it affected electricity prices, or whether it made it easier to sell investors because you could tell them, hey, what are you gonna do? Put it in the bank and get no interest on it? So what effect has COVID had?
It accelerated this whole trend of Bitcoin and Bitcoin mining. It accelerated the idea that this industry is not safe and it's not secure when it comes to an investment return, and that other industries are better. So it said, like, commercial real estate, it showed us that there's a bubble. It showed us that, this is really not going to work. It showed us that, there's other areas where we thought we were doing fine in energy, like solar farms. They're like, oh crap, when people on COVID aren't using energy and we're all producing a ton of it, and the power prices drop and crash, as you mentioned, that does a lot to our business. So I think all these companies came out of the woodwork. So we're like, how do we innovate? How do we make the future? And that is huge, because I think it's going to provide, a better overall ecosystem to the world. And we're seeing cryptocurrency mining playing a role in that.
Well, it's really exciting times for everyone, especially the people who are long on the price of Bitcoin, like mining operations. So JP, I appreciate you taking the time, and really interesting, letting me know a little bit behind the scenes, kind of the math and the financing, how it works for Bitcoin mining. I usually get to see the other end of just the blocks get mined. So JP, I appreciate you exposing a little bit of the magic behind the scene, and I appreciate you taking the time. And for all our viewers here at Reimagine 2020, I'm Yonah Hochhauser. Happy holidays.